9 out of 10 studio owners I talk to are undervaluing their business by more than half. Not 10%, by half. And it's almost never because the studio isn't performing. It's because they're looking at the wrong number on their tax return. So if you've ever thought, I've built something real here, but I don't know if anyone would actually pay me for it, stay with me for the next few minutes. I'm going to show you the exact math a buyer runs, the number that you should be looking at instead, and the 5 things that decide whether your studio sells for 2 times that number or 3.5. Here's the mistake almost everybody makes. You pull up last year's tax return and you look at the profit line, and you see something like $18,000. And you think, okay, so my studio is maybe worth 50 or 60 grand? That's not how buyers value a business. Buyers do not buy your profit line. Your profit line is a tax number. It has been deliberately squeezed down by every legal deduction your accountant could find. And that was exactly the right move for your tax bill. But it's the wrong move for your sale price. What buyers actually look at is called seller's discretionary earnings. And that answers a completely different question. Not what did the business report as profit, but how much total financial benefit does one working owner pull out of the business in a single year? That's your salary. That's your health insurance, your car. That's every dollar that flowed to you, not just what was left on the bottom of the page. Now let me run a real one for you. I've changed the details here, but these are the kinds of numbers I see every week. A studio doing $420,000 in revenue. The tax return showed $18,000 in profit. Now we rebuild it. We start with the $18,000. We add back the owner's wages and the payroll taxes on those wages. That's $58,000. We add back the owner's health insurance, another $9,600. We add back depreciation, which is a paper expense, no actual cash left the building, of $11,000. We add back the interest on a kiln loan because the buyer will have their own financing, $3,200. We add back the kiln you replaced last year because that's the one-time cost that it isn't going to repeat, $12,000. And we add back the personal side of the vehicle, the phone, and the industry conference you went to last year, $6,500. So that comes to $118,300. Now we apply a multiple. Across all small business sales right now, the average is sitting around 2 7/10 times cash flow. Retail-facing businesses under $1 million in earnings typically land somewhere between 2 and 3. So let's be conservative and we'll call it 2.5. $118,300 times 2.5. That's $295,000. Same studio, same year, same tax return. The owner had $54,000 in their head. Now, if you want to run those exact numbers on your own studio without doing all that math by hand, we've made this easy. We built a studio valuation calculator that does it all for you. It walks through the same rebuild just like I just did, line by line, and gives you a range at the end. It's from us here at PYOP Accounting, and the link is in the description. Go grab it and run your number, and then come back for the rest of this, because everything after this point is about making that number bigger. Now here's the catch, and this is the part nobody tells you. You can only add back what you can prove. If you ran personal expenses through the business but coded them as supplies, a buyer's accountant is going to go looking during the review before closing, and they're not going to find a clean trail, and that add back gets struck from the number. At 2.5 times multiple, a $5,000 add back that you can't document costs you $12,500 at the closing table. And there's a bigger version of that. If you took cash sales that never made it onto the books, that revenue doesn't exist. Not to a buyer, and definitely not to a lender, because a lender underwrites the entire deal off your filed tax returns. You cannot sell income you never reported. Clean books are not a compliance chore. They're the single highest return thing that you can do in 2 years before the sale. So what pushes a studio toward 3 times instead of 2? 5 things, and all 5 are specific to our industry. The first one is how much the business depends on you personally. If you're behind the counter 40 hours a week, you're not selling a business, you're selling a job. Buyers discount that heavily. A studio with a manager who can run the floor, handle the ordering, and owns the party calendar without you is worth meaningfully more than the identical studio where you are the operating system. The second is revenue that's already booked. Your party calendar, your class enrollments, your memberships. Money that's contracted for the next 90 days is the closest thing our industry has to predictable repeating income, and buyers will pay a premium for that. Track it, report it, and put it in front of them. The third is your lease, and this one kills more deals than anything else on the list. A loan to buy a business runs about 10 years, and the lender wants your lease term, including your renewal options, to be able to cover that loan. So if you have 22 months left and no option to renew, you don't have a valuation problem, you have a deal that cannot close. So go negotiate renewal options before you ever list. It costs you almost nothing and it protects the entire sale. The fourth is the money in your account that isn't actually yours. Yes, unredeemed gift cards, deposits on parties that haven't happened yet. That money is sitting in your bank account and it feels like revenue, but it's not. It is something you still owe. The buyer inherits it and it comes straight off your purchase price at closing. So know that number before a buyer finds it for you. And the fifth is your equipment and inventory, being honest. Kiln age and condition, the bisc count valued at what you paid for it, not what it sells for on the shelf. A real current count builds an enormous credibility during the review, and a guess can destroy it. So if you're anywhere inside the 3-year window of selling, here's the order I'd do things in. First, separate personal from your business today. 1 clean credit card, 1 clean bank account. Start documenting those add backs as they happen instead of trying to reconstruct them 2 years later. Get your lease renewal options extended and build a managing layer so the studio runs when you're not standing in it. Do those 4 things and you don't just sell for more. You end up with a business you might actually enjoy owning, which is funny enough why a lot of owners who go through this process decide not to sell at all. So here's what I'd do next. Start with our calculator. If you want to know what your studio is actually worth, we built that studio valuation calculator and the link is right below in the description. It's free, just takes a few minutes, and you'll walk away with a real number instead of a guess. Then, if that number surprised you in either direction, book a discovery call with us. That's where we'll go through your specific situation, your real earnings, your realistic multiple, and what's holding it down right now. That link is in the description too. We work with Pottery Studios specifically, so you're not going to spend the first 30 minutes explaining what bisc is. And if you're not ready to sell yet, but you want your books built so that this is easy when you are ready, subscribe. That's most of what we do on this channel. I'll see you on the next one.